Hey everyone, welcome back to Corporate Dakota, the place where we uncover the hidden stories behind those fancy corporate filings. Today we're diving into Equus Total Return Incorporated's latest report. And folks, it's a bit of a mixed bag, like finding a diamond in a pile of well. Let us explore before we jump in. If you love getting straight to the point with financial insights and understanding what these reports really mean, make sure you are subscribed. And if you want to chat about these findings with fellow finance fans, our Discord channel is linked in the description below. So Equus Total Return Incorporated has filed an amendment to their quarterly report. Why the amendment, you ask? It seems they just forgot to add some digital tagging called inline XBRL in the original filing. No big changes to the actual numbers, just a little housekeeping. This means the original report is still the one with the real story in it. And this amendment is just to make it more digitally friendly for the SEC. Equus Total Return Incorporated is a company that has been around for a while, formed back in 1991. Their main goal is to give their investors the best possible total return, which means a mix of making money from their investments and also from selling those investments for more than they paid. They used to be called Equus Incorporated, but changed their name to Equus Total Return Incorporated to better reflect their strategy of aiming for the highest total return. They invest in companies that are not super huge, usually with a total value between $5 million and $75 million. Let us look at the money side of things. As of the 30th of June 2024, Equus had total assets of about $103 million. Liabilities, which are what they owe, were around $54 million. This leaves them with net assets of about $50 million. When we compare this to the 31st of December 2023, their net assets grew from $48 million to $50 million. That is a nice little bump upwards. Now, let us talk about what each share is worth. The net asset value per S-share stands at $3.66 on the 30th of June 2024. This is up from $3.55 at the end of 2023. So, on paper, each share is worth a bit more, which is always a good sign for shareholders. Looking at how they made and spent money for the first 6 months of 2024, their total investment income was $614,000. But get this, their total expenses were a hefty $2,584,000, which is $2.5 million. This resulted in a net investment loss of almost $2 million for the first half of the year. Keep in mind this loss is from their core investment activities. However, they did make some money from selling investments. They had a net realized gain of $75,000 from trading US Treasury bills in the first half of 2024, and the value of their other investments, the ones they still hold, went up by $3.4 million. This helped offset the investment loss, bringing their total increase in net assets from operations to about $1.5 million for the first 6 months of 2024. Where did the cash actually go for the first 6 months of 2024? Their operating activities used up about $13.5 million. This is why they had to borrow money through their financing activities, bringing in about $9 million from borrowings under their margin account. At the end of the day, their cash and cash equivalents dropped by about $4.5 million. This shows they are spending more cash than they are bringing in from their day-to-day operations. Let us talk about efficiency. The ratio of expenses to average net assets was about negative 5.27% for the first half of 2024. This is actually quite good, meaning their expenses are lower compared to their overall assets. Their net investment loss to average net assets was about negative 4.02%. This means their core investment activity is losing money. Now, for the interesting part, what exactly are they invested in? As of the 30th of June 2024, their investments are heavily concentrated, about $46.5 million, which is 46.3% of their total investments, is in something called control investments. Majority owned. These are companies where Equus owns more than 50% of the voting stock. One of these major investments is in Equus Energy, LLC. This company is wholly owned by Equus. They are in the energy business, and their investment in this company has a fair value of $10 million. The cost of this investment was about $8.1 million. Another big control investment is in Morgan E&P LLC, also in the energy sector. Equus has put about $26 million into this company, and its fair value is also $26 million. They also have a 12% senior secured promissory note for $10.5 million. Putting it all together, their total investments are valued at around $100 million. The majority of this, about $46.5 million, is in these controlled energy companies. And what about their safe bets? They hold a significant amount in US Treasury bills, totaling $53.9 million. These are considered very safe, and they represent a large chunk, 53.7%, of their total investments. Now let us see how they value these investments. A big portion, $46.5 million, falls into the level 3 category. This means their fair value is based on unobservable inputs like educated guesses and internal models, because there isn't a ready market for these specific investments. For us, treasury bills, which are traded on open markets, they are valued at $53.9 million using observable market prices. Looking deeper into these level 3 investments, the big chunk is in control investments. For Equus Energy LLC, the valuation techniques involve things like acreage value per acre, proved reserve multiples, and discount rates. For Morgan E&P LLC, it's similar, using reserve multiples and discount rates. These are complex calculations, and they show how much judgment is involved in valuing these privately held companies. The notes to the financial statements give us more context. Equus invests in companies with a total enterprise value between $5 and $75 million. They are a business development company, or BDC, meaning they invest in smaller and growing businesses. They also aim to be a regulated investment company, or RIC. For tax purposes, which means they avoid paying corporate taxes if they distribute most of their earnings to shareholders. The oil and gas sector has been wild. Crude prices have bounced around a lot. Natural gas prices are more stable now. This volatility affects Equus Energy and Morgan E&P LLC, where they have most of their controlled investments. The report mentions that while oil prices are up, the companies might need to secure financing, shut in wells, or sell assets to keep going. This is a major risk for Equus. This next part is crucial. Equus has about $1.9 million in cash and cash equivalents as of the 30th of June 2024. However, they have $46.5 million invested in portfolio securities. This means they do not have enough cash on hand to cover their short-term needs. They even state that there is substantial doubt about their ability to continue as a going concern, which is a serious warning sign. They might need more loans or investments, or have to sell off some assets. Let us look at Equus Energy, LLC, their wholly owned subsidiary. It's facing its own challenges. The report states that there is substantial doubt about Equus Energy's ability to continue as going concern. They are looking for financing, considering shutting in wells or selling assets. Then there is Morgan E&P LLC, another subsidiary. They also have significant investments, and the fund has provided them with $10.5 million in debt financing. While the fund's management believes this financing somewhat eases concerns about Morgan's ability to continue as a going concern, it's still a closely watched area. In this section, Equus talks about its strategy and the risks. They are still looking for companies to invest in, but also exploring the idea of becoming an operating company instead of just an investment company. This is a big potential shift. They are also dealing with a significant discount between their stock price on the stock market and their actual net asset value, per share. Here is a red flag though. Management identified a material weakness in their internal controls over financial reporting, specifically related to valuing their investments. This means to raise a chance of errors in their financial reports that could go unnoticed. They are working on fixing this, but it is something to be aware of. The exhibits list out important documents like their articles of incorporation, bylaws, and incentive plans. These are the nuts and bolts of how the company is set up and governed. Alright, let's break down Equus Total Return Incorporated. Looking at the financials, there are some positive signs. Their net assets per se have increased, and their expense ratios are looking good. However, the big concern is their liquidity. With only about $1.9 million in cash and over $46 million tied up in investments, they are walking a tightrope. The mention of substantial doubt about their ability to continue as a going concern for both the parent company and Equus Energy is a serious warning. They are heavily concentrated in the volatile energy sector through their subsidiaries Equus Energy and Morgan E&P LLC, while the report indicates efforts to secure financing for these subsidiaries and a potential shift to becoming an operating company. The risks are substantial. The material weakness in internal controls over financial reporting also raises questions about the reliability of their financial statements, though they state efforts are underway to remediate this. So, what is the strategy here? It looks like a company trying to manage significant risks in its core investments while exploring a major strategic pivot. The heavy concentration in energy and the liquidity crunch are certainly areas to watch very closely. The potential move to an operating company could be a significant positive if they find the right opportunity. But the path there is fraught with uncertainty. What do you think about Equus Total Return Incorporated's report? Are you concerned about their liquidity and energy sector exposure, or are you optimistic about their pivot to an operating company? Let me know your thoughts in the comments below if you found this breakdown helpful. Please give this video a thumbs up, it really helps the channel. And if you want more deep dives into corporate filings, make sure to subscribe. You can also join our Discord community in the description for more discussions. Thanks for watching, and we will see you in the next one.